those two elements to connect mining companies more with who they are supplying to, as opposed to just the extraction activity, and then being located in regions that are strategically friendly to the Western world, those are differentiating factors that mining companies, particularly at this conference, should probably benefit from.
Where we place some of our longer term and strategic equity is in these types of opportunities as well, where they're developing recycling technology or trying to repurpose and reprocess old waste and tailings material as well. I think that that's really where the future is going to bridge some of that critical sourcing.
I think we need to start thinking about the sector in a different way as the rest of the world and governments think about it in a different way, and how it's funded.
Straight on to some of the themes for this morning. We're going to be talking about some of the major headline themes that are hitting metals and mining at the moment, and looking at across the investment ecosystem. And so I'd like to invite to the stage our guest panelists, Istvan Zollei, Portfolio Manager of Orion Resource Partners, Lenny Tsatskin, Vice President of Gerald Group, and Julian Treger, CEO of Audley Capital. Thank you, gentlemen, for joining me. Mark Rice of Orion, who was advertised to be speaking, is unfortunately unable to make it. He had to be in Toronto at quite short notice. So that's unfortunate, but he sends his apologies. Where do we begin, really, with this very interesting economic backdrop that we find ourselves in? It'd be an understatement somewhat to say there's a great deal of risk out there at the moment. Plenty of crises going on, whether it's war in Europe, exacerbating the energy crisis, summer droughts and food scarcity, many factors intensifying this race for natural resource security. So I wanted to start by putting into context where the panel feels we are at in terms of the market cycle for metals, mining, and commodities. Specifically, is this a particularly delicate point between a long-term positive fundamental view and a short-term great deal of risk and uncertainty? And so perhaps we could work through. Istvan, do you want to take us first?
I think you have to look at a lot of different types of metals because it's not the same cycle for each.
Okay.
And so I think that basic couple of three different groups that you could focus on is precious metals, primarily gold, as a safe haven asset in an inflationary environment with war, probably pretty well positioned in the near term. Then you have base metals that participate in energy transition with lots of government support, fiscal stimulus supporting those sectors, such as battery electric vehicles or renewables. Those metals are probably in a very good long-term demand cycle. And then there are some minerals that are not part of the energy transition, currently in great demand, such as coal, iron ore. The longer-term future is probably more difficult to predict. So I think you have to really look at each and every one of them.
Yeah, absolutely. Okay, so sort of fragmented landscape, certainly in the near term. And in terms of Orion, you're going about it in that approach. Are you sort of looking at coal now that it's more interesting, or do the market dynamics suddenly make certain commodities more attractive again?
Our primary focus, I would say, of these groups is energy transition base metals, battery metals. Gold has always been a focus for us, so that will continue to be part of our investment mandate. Coal has not been and probably will not be based on our investor base.
Yep.
So that's how we are aligned.
So it's more of a long-term view in terms of that stability. Excellent. Julian, can I get your take on the
Sure.
sort of
I mean, I
risks?
think obviously there is some short-term pullback in commodity prices with uncertainty in demand, and certainly the stock markets are difficult, and there's not lots of inflows, and people are very cautious about committing new capital. But I think this year has been really important for our sector because it shows, the weaponization of natural resources is bringing home the importance of our sector to the world. And we are seeing initially, of course, much more coal being used, but that's increasing the urgency to get to the net zero stage. So I think in the short term, it's not all good, but in the medium term, it's really super interesting. And one of the themes I'd like to make this morning is that the sector is really changing fundamentally as a result of this. So the traditional way of mining, the traditional way of financing mining, I think is altering, and governments are going to start crowding out the private sector in terms of funding things and making sure that they've got their stockpiles. And then in Silicon Valley and all over the world with VCs, there are huge amounts of capital to be put to work in these transition metals. So I think we need to start thinking about the sector in a different way as the rest of the world and governments think about it in a different way, and how it's funded.
Yeah, absolutely. So it's becoming more strategic in the sense that it's pulling in, or at least we're poised to pull in newer forms of capital and sort of, strategic governmental plays rather than, that historically haven't really been there.
Yeah, so there's actually a much bigger pool of capital, but one needs to think how one accesses it. But the traditional sources of capital have shrunk.
Yeah.
And so we need to, and a lot of the models that we see don't really take into account the various government subsidies and carbon credits which are going to be available to the sector. But I have, in the last couple of weeks, run across a couple of businesses which are purely based upon US subsidies for, capturing, escaping methane from pipelines. And I think as a sector, we need to think a bit more about how we start to communicate the carbon benefits of what we're doing.
Certainly. Some great points there. We can delve into a bit more detail in time. Lenny, as your first speaking occasion for one-to-one, could you introduce Gerald Group, just because we haven't had you up on the
Yes,
stage
absolutely. So Gerald's one of the oldest and largest independent metals traders in the world. We've been around for about 60 years, have a strong global footprint, but alongside that, we also have a pretty strong investment and financing footprint. So we've deployed close to $2 billion in the last decade that I've been with the group. Primarily, it's to build up our own trading business and secure long-term trade flows and improve trading margins as things get volatile and challenging in the market. And just to build up more on what Istvan and Julian have said, I think we see the same thing. We segment the metals into three groups, being the precious metal sector that's really driven by what's happening in the macro environment, and then the base metals and the energy metals that'll be very much driven by the energy transition, and then some of the other metals like coal and iron ore that are very bulk commodities and will, the future is a little bit uncertain at the moment. And we are seeing a lot of alternative capital and new types of investors going into base metals and energy transition metals. Ourselves, we are seeing a lot of participation now from parastatal entities, from Afrexim and various African banks and parastatal entities. The DFC is now getting more involved because there's a big shift and paradigm shift in between Chinese versus U.S. geopolitical tensions and being able to secure these transition metals. And you're seeing a lot of drive coming from that space as well. So, very much agree with what the two of them are saying. For us, we are very much focused on energy transition metals and financing those types of projects. I think that in this risk and uncertain type environment, the new types of financing is shifting to the sidelines and taking a wait and see approach to see what the best opportunity is as a first type of investment, particularly, Silicon Valley investors and parastatal entities. I think they need to see how things play out in the coming months on a macro level with all the geopolitical events and war and COVID coming down. For us, this is our prime moment when we look at investing, because these traditional capital markets, the capital tends to dry up and sit on the sidelines. So for us, it's an opportune moment to take on a little bit more risk. We have a little bit more risk appetite compared to a traditional financing institution. So, you need to know where the capital is at certain cycles and where to look for it.
Yeah, interesting. So an opportune time if you're there and you're positioned as an expert. Let's talk about some of the trends in more detail then around this financing. You mentioned alternative capital forms now because the public markets obviously are suffering so much. Could you delve into a bit more detail around specialist finance that is available, other than obviously yourselves and when you want to act, and of course the markets don't seem to be coming back anytime soon in a big way. So it obviously leaves a bigger gap for firms like yourselves to exploit, I suppose.
Yeah, I think it's been an interesting 2-3 years, right? We've gone from capital markets completely freezing up in 2020 and seeing very limited transactions to the great thaw and awakening where so much capital went into metals and mining, new types of investors, new sources of capital. And for a while, the mining companies were playing catch up and putting out feasibility studies, developing out to a point where they're ready for investment from these alternative types of funds. And I think that a lot of them got to that point, and now some of that new capital has stepped aside, right, as we spoke, and they're waiting to see what happens. So at this point in time, you're looking at alternative credit funds, opportunistic investors, distressed asset investors, alternative private equity funds. I guess the return threshold's a little bit higher for these groups. You're not going to get single-digit financing like you would potentially from a bank or from a large institutional investor, but the capital is there. I think the mining side needs to now adjust their expectations and go out and be willing to pay a little bit more.
Interesting. Yep. Istvan, do you want to comment a little bit more about how the trends in financing and the landscape's changed?
I think Lenny brings up good points, but I wanted to bring a little bit different perspective. Two interesting trends that I wanted to bring up. One is the rising interest rate environment means that the cost of debt financing goes up. The cost of returns for anybody that invests in any type of capital should be going up. So that's an important trend that mining companies and financiers need to think about. The other one is with capital escalation or inflation. That means that mining companies need to spend more money just to produce the same quantity that they were producing before. So if we actually want to incentivize new supply, additional supply, then there's even that much more capital that needs to be spent. And for that reason, I'm a little bit less focused on whether traditional financing sources like great project finance banks or equities more or less, but actually we need all of those. I think mining companies need all of that. And what I would like to focus on at Orion is to work with somebody like ING, work with traditional capital providers, traditional equity investors, because you need all of those sources, not just to keep supply at the same level, but actually to increase supply to meet the demands from energy transition and other types of minerals. So I think the challenge in the rising interest rate environment is certainly that your equity returns should also be much higher, streaming returns should also be higher, and the debt returns, of course, are all going up.
Yep. It's a difficult environment in that respect. Yeah. Has anyone else Julian, do you want to comment on the inflationary impact at the moment? Is this making project finance unfeasible for certain projects, certain smaller projects?
We'll talk about this later, but I think one of the trends that we need to see more of in the sector is using new technologies to keep costs down and reduce them. And I think that's going to be a way in which, the squeeze that's currently occurring on a lot of miners where the commodity prices are lower and their costs are higher can be mitigated. But I wanted to talk about another point with regards to financing, which is, for better or for worse, this sector has been led by precious metals and gold. And that's what most investors have thought about. And gold actually hasn't performed that well in the current environment. You would have expected with nuclear risks and the war and high inflation, it would have gone up, but it hasn't. And one of the themes that we are seeing in this talk is the way in which the baton for leadership of the sector is going to move from precious to energy transition metals. And, in that environment, you have to ask what the utility of gold is. Why do we need to have more gold mines when it's not clear actually how that changes the way in which the world operates for better or for worse. So I think the sooner we can make this transition, the more we can attract new capital and that broader pool of capital. And then with more supply of capital, the cost of capital will start to go down.
Yep. Interesting. I don't know, Istvan, if you want to chime back because you guys do invest in gold and precious metals, as you said. Obviously the price isn't moving the way you'd have thought with risks in the world, but equally the strong dollar and the sort of the sensationally high, US market over the last few years has probably suppressed that. There's no financial risk there at the minute. Is that right?
Well, there's kind of two different aspects to think about. One is gold as an asset, the other is gold mining companies, and the two are not necessarily the same. But generally speaking, Orion continues to invest in gold mining projects because the gold market in general plays a couple of important roles. It tends to provide low correlation to other asset classes, so it helps an investor who has more like an all-weather strategy in all economic environments. It provides a good diversification. It provides historically really strong performance in times of volatility or inflation. And certainly in the current environment, that's potentially a good environment for gold on a relative basis. And finally, gold is very liquid, much more liquid than other metals. And the liquidity of gold as an asset, not gold mining companies, is similar to US treasuries or some of the big foreign exchange markets. And so that liquidity in gold has also translated to gold mining companies, generally speaking, having better liquidity in their equities, better liquidity from a banking coverage, like bank lending, and having a more evolved royalty and streaming market. So those are favorable characteristics, but I also agree with Julian that certainly there's a more coherent generalist argument that you can make for battery metals, energy transition metals.
Yeah.
So for Orion, we continue to focus on both, but certainly there's an important shift.
Interesting. Lenny, you were going to chime in before I interjected. Do you have a further comment on that or a view on this baton shifting to the new commodities?
Yeah, I mean, I definitely agree with the views on gold. I think it's struggled to maintain the same, macro expectation that we would have from it, given the rising interest rate environment and economic uncertainty. You would have thought it would perform a little bit better than it has. But, there's also the current battery metal environment with tin, cobalt, copper prices back down, well below their highs just last year. And I think what's going to start to happen is at these price levels, there's not enough incentive for the capital markets to finance the projects that we need to drive that energy transition. And so long term, I think we're fairly bullish on where those prices are going to end up going, because this can only last for so long. If you plan on achieving all the infrastructure projects and the renewable energy projects that you need to drive this massive energy revolution, then copper supply alone is nowhere near where it needs to be. And I think that long term, we need to have a much more positive outlook on prices there. Whereas with what's happening with gold recently, you start to question a little bit if it's still that safety net and that safety asset. And in terms of liquidity, how much more it really is of a liquid market compared to these new battery metals.
Yeah, interesting. So you
Yeah, but I agree with that. But do you think that there's a scenario which I think is possible, that at some stage governments start to guarantee a certain price for new mines in order to secure the supply, and start to sort of provide sort of price puts for manufacturers? Certainly, like in uranium, people are saying that's necessary. And I think that could be a development which starts to occur more out of the US, because the US has more money. I'm advising the UK government on their critical minerals, but I don't think they have the money they've identified the minerals they need, but they don't know how they're going to get them.
I don't know that necessarily there's going to be a price fixing or a floor that's going to be driven by the government. Where I think the government's going to start adding value is through grants and essentially guarantees they provide that these mining companies will remain solvent and will support financing and developing these projects more so that they can advance, and there's enough cost savings initiatives and a certain level at which they can profitably operate. So probably tax incentives and government grants and guarantees to drive that forward.
Do you think there's enough of that happening, enough capital from the governments or enough initiatives or enough tax incentives in the sort of Western hemisphere, ex-China, basically, at the moment, or is it too little, too late? The Inflation Reduction Act has seemed pretty positive in some of the things that it's working on. I don't know how that's going to trickle into mining projects specifically.
I think governments move slow, but they're starting to move. We're definitely seeing a lot more participation from the Department of Justice. Even I sat in, and the State Department as well. I sat in on a panel at Indaba, and the Secretary of State, or the Undersecretary of State overseeing this, had participated, and the U.S. really wants to get involved in Africa, very much so. And we've been engaging in some discussions on some of our projects within our portfolio with the DFC, and they've restructured to be able to be a little bit more agile and provide capital and guarantees. So I absolutely do see it, but it comes at the pace that the government works at.
Yeah, absolutely. Okay, interesting. Let's focus then on the companies. Let's talk a little bit about how you've seen the sectors performing. We've had some very irregular but extraordinary couple of years, but where do you think the mining companies are at right now? Maybe we'll talk through the tiers as well. Are the majors performing as you'd expect? Are they sort of range bound with their sort of agenda on M&A? And we'll work our way down through the tiers. But Istvan, do you want to share a comment perhaps on the major miners first?
It's been an eventful couple of years, but generally speaking, starting at the biggest companies, the diversified, biggest mining companies that have been well exposed to windfall type pricing environments in iron ore, coal, and some other minerals, they've had a fantastic performance. They paid double-digit dividends, 10 to 15% dividend yields, and they perform really well. Their balance sheets are in amazing shape relative to previous cycles over the last 15 years. So I think they've had a really good performance. Mining companies, a lot of companies, for example, at this conference, who are not diversified multi-asset companies, maybe didn't benefit as much over the last few years because they didn't have the revenues to reap the benefits. And so one of the challenges for the smaller companies is that we haven't had a sustained enough long bullish cycle over the last few years to really allow them to raise money and build mines. At least the window was quite short until now. Maybe it will improve. So I would say that if you look at the performance of mining companies, you really have to differentiate between different groups.
Yep, absolutely. And so in terms of your investment targets then, you're very much on a project by project basis. There's no way you can cast sort of a segment or a broad brush. It's got to be so specific.
Yeah, we are looking at partnering with all kinds of mining companies that are looking to build or buy mines. So but if it's a big company or a small company, it doesn't make a difference.
How early stage does Orion look at that sort of risk capital?
Every stage. Right. So we have conversations, small investments in every type of company. Obviously, the preference would be for bigger, better capitalized, more experienced companies, but the range spans really broadly.
Certainly. Okay, excellent. Julian, do you want to comment on the mining tiers and who's performing well?
Yeah. So, I mean, clearly the majors have done extremely well, but, following that thesis of returning dividends to shareholders and not investing in new capacity, I think that they, in hindsight, will have missed some opportunities to do some destructive and creative reorganization over the past couple of years. So, they haven't really, despite some sort of lip service about being green, they haven't really, transformed. And I think what's interesting about our sector is we haven't seen really any great challenges to the incumbents for the last 50 years. It's still the same players. And, even Mark Cutifani, who I love and got the sort of green message, couldn't change Anglo-American in any substantial way as CEO for 6 years. So the cultures are very much fixed. They're making a lot of money. They're in a good position. I think for the other companies, we do need to think in a different way, because this is a sector in transition. The sort of traditional mining, in my view, is going to be important still, but it's part of the past. And now we're going to be in a much more complicated world, which is much more strategic. I think what's really exciting for the sector about the breakdown of globalization is that national supply chains are much more inefficient. So this is going to create a lot of demand for strategic commodities, which wasn't there before. So the demand side looks great, and I think the companies need to reposition themselves as supplying that strategic, need. And as I said, we need to think more about how we show what the carbon credits are, the value in use of the materials. We need to be changing the way in which we present to be more appealing to these transition energy pools of capital, which are much, much larger.
And just to chip in on that, and I had this discussion with Julian a lot, I totally agree with him, and it's an important message for mining companies to perhaps be more relevant, is to focus less on the fact that they're extracting minerals, to focus a little bit more on they are critical suppliers to Tesla, to other major companies. And that is an important trend. I mean, all the major car manufacturers have signed offtake contracts with either governments or companies in those those parts of the world that are viewed as either free trade countries to the US or generally safer jurisdictions. And so that those two elements to connect mining companies more with who they are supplying to, as opposed to just the extraction activity, and then being located in regions that are strategically friendly to the Western world, those are differentiating factors that mining companies, particularly at this conference, should probably benefit from.
Yeah, so I think, I've said this before, we don't want mining companies to show diggers and holes in the ground.
Yeah.
Louis Vuitton doesn't show crocodile farms or dead crocodiles when they're selling their handbags. You've got to really market the benefit. And we are, keeping the lights on. And people are appreciating that more and more.
Yep, certainly. So a lot of it's a messaging piece, but equally there's a technical piece as well, like you say, getting closer to the value chain and the end user. But we're starting to see that, right? The scramble for materials on the OEM side. Everyone's looking upstream, maybe even starting to put equity in now, not just simply offtakes. If we think about Stellantis with the Peugeot group, I forget, in Europe, for instance.
It's not obvious, and I'm really curious about Lenny's experience in this. I just was at a recent conference where Richard Eckerson, the CEO of Freeport, said people have been talking for 40 years about Freeport selling copper directly to car manufacturers at a higher price. And he said for 40 years, it's never happened.
Right.
It's viewed as a commodity, and regardless of what people say. So that was a very interesting perspective, because you see some counterexamples to that. Tesla entering into offtake agreements with direct mining companies, such as Vale. So I'm not sure there's a clear trend, but it would be a very interesting development for sure. I'm not sure, Lenny, have you seen that?
Yeah, absolutely. I think you're starting to see a lot more of it, and particularly in areas where it's not as commoditized and as liquid, such as lithium and what Tesla is doing. I think in other sectors and other long-term supply agreements for metals like iron ore and copper and even precious metals, you're still going to have some value from an intermediary just because you can assure the supply chain a little bit better. So for example, if you are General Motors and you're buying, palladium, which became quite critical, if you're tied to one contract with one producer and there's a massive supply chain disruption, that trickles down quite quickly. But if there's an intermediary like a trader who has multiple sources, you kind of de-risk that. And then there's also the working capital concern for a lot of these companies, in that there's a long logistics cycle from the time the mine produces it to the time somebody like General Motors can possibly need that palladium. And so there's a lot of inventory financing, working capital financing. And I think that banks try to step in and bridge that a bit. But there's also the whole execution risk and the operational side of it involved. You will see a lot of these companies probably go in and set up their own trading shops to kind of act independently and alleviate some of that. But I still think, for a lot of these, you're going to have intermediaries for a long time.
And Lenny, how do you see these OEM type companies balancing the sourcing requirement with some new legislation that mandates that all your materials have to come from, Western or friendly jurisdictions, but at the same time ensuring supply availability, like the chip shortage, and also the pricing. They want to have lower prices to counteract inflation. So how do you see I guess your customers balance that.
Yeah, I think you can't have your cake and eat it too in this case. Unfortunately, a lot of these critical metals are coming from more challenging jurisdictions, and it's nice to want first world critically sourced metals and U.S. Based tantalum, but it comes from West Africa and places like Colombia in the middle of the jungle. So I think that companies are going to have to adapt. There's going to have to be much more stringent audits and certifications, and you're seeing that happens very much so in tin, for example. And I think that that's more likely the long-term solution rather than setting very specific requirements for where these metals are sourced.
But I mean, one of the things that I'm interested in is I think that the rise of the circular economy and recycling and reprocessing will help to plug that gap. It's not going to be enough, but I think we will see much quicker growth in that part of the commodity extraction sector than in traditional mining, because that's a sector which is in its infancy, and in the future it will be seen as madness that we used to take our national heritage of waste, which is our assets, and export them to Bangladesh or Guatemala or Ghana, wherever. We should be keeping those things. They're our past, but they're also our future. And so that business is going to become a big business, and it will be one of the ways in which the West plugs the demand gap.
Yeah, I wholeheartedly agree in that. And where we place some of our longer term and strategic equity is in these types of opportunities as well, where they're developing recycling technology or trying to repurpose and reprocess old waste and tailings material as well. I think that that's really where the future is going to bridge some of that critical sourcing.
Is that recycling mainly in the sort of bulk and sort of copper related transition metals? Is it practical, or is it advanced enough yet in some of these niche metals?
It's not. I mean, the best example you can go to is lead, where in the U.S. it's a 99% closed loop process, and it's all most of the lead that's being recirculated is recycled material. I don't think for metals like copper it's quite there yet. I don't know the exact statistic, but I think maybe only 10% of the world's copper supply comes from recycled metal. So a third. It's hard to, if you look at overall global supply demand fundamentals of copper, it's hard to believe that a third can come from recycled material. I just don't see the infrastructure.
Do you think the technology is there for real recycling to occur from end use products like lithium ion batteries?
From what I've seen so far, it's a very labor-intensive process. So where it's happening is places where there's cheap labor to actually separate things. Where I see some of the innovation is in that separation technology. I don't think it's quite there yet on a commercial scale. I haven't seen one specific solution that will work across the board. I've seen stuff at lab scales and smaller pilot studies, but nothing yet that's so commercially viable.
Just to add something interesting to that, Orion also believes, and Julian actually works really actively in this area, there's a lot of new capital required for these new industrial processes, new industrial technologies to utilize the metals. So we as a group shouldn't just think about capital for extraction, and Julian is really active. He has multiple companies involved in industrial innovation, technology innovation applied to metals and minerals. So maybe Julian, you're actually better pleased.
Well, we have seen recycling technologies for the bulk, so for coal, iron ore fines, steel slag, ferroalloy waste, but also up to, and one of the businesses we've invested in is recycling magnets and extracting the rare earths from magnets. So I think people are really hard at work to solve these issues. And what's interesting, actually, going back to mathematics about the large companies, they haven't succeeded in innovating. I mean, they've had Rio Ventures, BHP Ventures, all these things. They've thrown a lot of money at them. They actually haven't come up with enormous inventions. I think Vale has bought a couple of things and they're using them for their business, but in general, the majors haven't. But within the universities around the world over the last decades, people have been, really hard at work and creating solutions. And so one of the great opportunities for our sector is to finance those and help provide a solution. And I think governments are going to be a major part of that.
I think it's a good avenue for the pool of Silicon Valley investors that you're talking about as well, like the Silicon Valley venture capitalists and SVB and those institutions. That's a great area for them to tap into if you're in that market.
Do you think they'll be more willing to do that? The sort of it suits their sort of investment mentality, their mandate, or is it a case that it's not sort of touching an extraction project, it's touching a recycling project, so therefore immediately it appeals to their sort of values, if you will?
Look, I think over the last few years with the SPAC evolution, there was a lot of capital invested or planned to be invested in this and other kinds of technologies. So this is a riskier area, requires different type of risk capital, not the same as a project financing from a bank or Orion. And certainly Orion is actively looking at this. The SPAC market was looking at these. So you require risk capital. It's definitely a different type of risk than metals and mining traditionally.
Yep.
I think one of the things we as a sector should do is educate the people on the West Coast or in these carbon transition funds about our sector. They understand its importance, but they don't understand how it works. So generally, they are used to basically throwing money at technologies and giving them a brand and having big name investors, and then that becomes dominant because 99% of all of our DNA is the same. So we look and see and feel basically the same. Whereas when you're dealing with metals, where you're dealing with elements, they're completely different. They're like totally different species from other planets. And it's a much more complicated and difficult world that they're involved in. And we need to educate them about that, and they will then appreciate much more the value that our sector is bringing to the game. So the people like at Silicon Valley Bank are investing in sensors and artificial intelligence, all things that they're used to, but they should be looking at much more fundamentally interesting processes, and we can all play a role in educating them.
It's happening a little bit, I think. So sort of Livent and Lilac Solutions, and it's got some of this VC money, and Bill Gates has got his, I forget the name of the VC fund, but it's
Breakthrough Ventures.
Yeah. And they've touched some of the technologies that are going into battery metals, not necessarily the mining company.
Yeah, exactly. It's happening slowly.
Yeah. Okay. Excellent. Does anyone have a question for the panel at all at the moment? We've got there's a gentleman at the back.
Valley is supposedly spinning off its copper and nickel assets. Valley is supposedly spinning off its copper and nickel assets, which is a disintegration move. Do you think that some of the multi-product companies are actually going to need to refocus more narrowly in the future?
Well, just this morning we were chatting with Julian about tech, following a similar strategy, disintegrating. It's difficult to tell. I mean, it could also be based on strategy or battery metals, energy transition metals, maybe currently more sought after. So it makes sense to disintegrate along those lines. I don't know if there's a clear trend, but we have seen tech do that with coal, or supposedly doing it around coal. Valley, this move has been in the works for many, many, many years. So I don't think it's a completely new initiative. It's tough to tell. I don't see a clear trend, but it's an interesting one.
Yeah, I mean, you've certainly seen some businesses like Randgold moving into more battery metals, so diversifying. I don't know Vale very well, but historically people said to me that their core competence was iron ore mining, not these other battery metals, and they didn't actually manage those businesses very well, and that the production was declining year on year. So maybe they've just decided that they should stick to their core competency.
Yeah, I agree. I think both of these things. I think the copper segment and the battery metal segment will eventually probably command a slightly better premium and maybe perform a little better on its own as a separate company, and they can focus on that. Vale, as it's known, is it's a bulk commodities business, and that's a whole different way of operating than a copper project would, where the focus is on the metallurgy and the refining process and very technical. With iron ore, it's how quickly, how efficiently and how fast can you move the metal using hundreds of kilometers of rail versus copper, which in terms of value, you load a lot of it into a container and you're good to go. And iron ore, the same amount as an entire vessel.
Yeah, and Vale, hasn't really, they lost a fortune in Mozambique on coal. They haven't historically managed to do much outside Brazil successfully, which is clearly their strong suit.
And just a couple of counter examples or different examples. Lots of Australian companies or West African companies are diversifying into base metals mining. Just this morning, Harmony Gold acquired a copper project in Australia. The Independence Group it's an Australian base metal mining company, has leaned into battery metals. And I think Fortescue, the great iron ore company, is also making very significant investments in energy transition. So I think you see just as many examples of more diversification as disintegration.
And I think the narrative there, and not to downplay iron ore, because for us, for instance, iron ore is our flagship asset. Iron ore is also going to play a very instrumental role in the battery transition, because all this infrastructure is going to require a lot of steel. And so that's going to be driven very much by iron ore still. However, I think there's going to be a shift where you're going to go for higher grade projects which help decarbonize steelmaking a little bit more, and shift away from some of the lower grade projects that are 58, 62% iron ore. And ourselves, for instance, that's what we're focused on, is the higher grade iron ore.
Excellent. If anyone wants to interject, yep, certainly. We'll take one here and then over here. Yep. Should be a microphone.
Yeah, Julian, earlier you mentioned cost-saving technologies. Could you further expound upon that and discuss what that might look like moving forward in the near future?
Sure. The technologies that we are looking at have a number of commonalities in my new vehicle, which is called Cotec. So they generally are using much less heat, much less water, and then historically, it used to be that you had to have scale to capture economies, and obviously people built huge projects and they were looking for huge deposits. But I think what we're seeing now is a trend towards capturing economies through flexibility and modularity. So a lot of these new technologies are more modular. You build a plant. So one of the things I've invested in is a business which can make pellets at ambient temperature. They don't need to have an induration plant, doesn't need 1200 degrees. And to build a little pellet plant will cost $20 million rather than $200 million. The OPEX may be similar, but the CAPEX is much lower. So I think there are definitely ways in which costs can be reduced. And obviously, the whole recycling, reprocessing side, you don't have to mine. It's like a brownfield sort of restart. So the cost base is much lower. So I think there'll be a lot of trends which use less energy, less heat, less water, and are more flexible, more modular. And that, I think, will help.
Thank you.
Yeah, gentleman back here.
Thank you, Quinn, an investor. Fairly broad question. What do you think is the biggest risk to the battery metal industry over the next 5 years?
How to tackle that?
I would say that 5 years is a pretty short time frame. If you think about the decarbonization or energy transition, it's more likely to play out over 10, 15 years. So if you look at a 5-year period, the path may not be linear. There may be a recession or economic decline based on war, pandemic, that are difficult to predict. So I would say that our perspective is a little bit longer term, and certainly we are a longer term investor. And I would say that over just the last few years, even this calendar year shows you that the volatility in the near term markets, the spot markets, is really, really high. So probably have a longer term perspective would be maybe suitable.
Yeah, from my perspective, I try and avoid crowded spaces. And this is a very crowded space. So there's like 250 gigafactories under construction. There won't be 250 in operation. So people are going to lose vast sums of money, but some people are going to make fortunes. And we've already seen issues like coming from the UK with British Volt, where you're throwing money at things, but operationally it's very complex. So I think it's obviously going to be a very important sector, but who's the winners is much more difficult to predict. And that, also probably goes for the supply chain. It goes for lithium, extraction, battery recycling. There's just so many different options. It's difficult to choose who's going to be successful.
Yeah, I agree with Julian. I would say outside of the macro factors that can, is a risk for any commodity in any operation is really the technology and execution risk that these guys are going to be dealing with over the next decade. That's really going to determine the winners and the real consolidation. I think picking the most efficient technology where it's cost effective, both downstream and effective in terms of the time it takes to process the metal, and as well having a captive supply chain that's consistent are going to be the two biggest risk factors for these companies.
Excellent. Unless there's any other questions, just wanted to move back to the M&A question that we didn't fully tackle when we were talking through financing trends, repositioning of portfolios. Do you have a comment on where do you think the M&A cycle is at now? Is it even a cycle at the moment? Are things quite irregular? Are we going to see a lot more activity or a lot less?
I wanted to loop back to something that Julian said earlier, which is discipline by mining companies. There's one particular data that we track, which is capital returns by mining companies to shareholders relative to capex that they are spending. And for the first time in 15 years, mining companies are returning more money than what they are spending. So that signals discipline, and they have used their windfall profits. These are probably the most diversified big companies. They've utilized that windfall to return to shareholders as opposed to going to binge to buy companies. And at the same time, their balance sheets are much better positioned than they've been for the last 10 years. So if they wanted to, they could easily pivot to making M&A deals. They haven't yet. Returning capital has been the priority, driven by activist shareholders or general market sentiment. But certainly they have the capacity if they choose to do so.
Yeah, one thing which actually Istvan talks about, which I think is very interesting, is the importance of market cap. And, everybody knows that Apple could buy, the mining sector with 1 year's cash flow or whatever the ratio is. So as the markets grow and these mega caps develop and they're what people are used to with liquidity, our sector becomes increasingly irrelevant. So I think there is going to be real pressure to, get the first mining company that's worth, $200 billion, etc. And I think that will drive some of the imperative to scale.
Lenny, do you want a final comment on M&A?
Agree with both of them. I think also focusing on some of the mining companies that are more junior and mid-size, such as the participants here. I think the opportunity is in consolidation and in M&A to be able to ride out long-term, challenging or uncertain economic cycles.
Yep.
And I think that diversification through consolidation is also helpful. So, consolidating a couple copper gold assets in the Southwest to make a mid-sized company that's going to be a little bit more sustainable and more risk mitigated for long-term survival. I think that's the way forward. Do I see the activity happening so much? No, not recently, I would say.
Okay. With 1 minute left, there was just one question at the back. If you can do it in 1 minute.
I'm curious about your opinions on the spot market, right? It's a pretty opaque market. We've seen Sprott kind of come in and do some trusts and move some of these battery minerals and uranium. And I'm just kind of curious as to how realistic you think that is. And, the gold market's developed, but these battery minerals don't really have a developed spot market, I guess.
Yeah, I think honestly, it's one of those crystal ball questions. I don't have a honest and concrete answer for you. The markets are very irrational right now, and something's happening every day to throw things off. I think the fundamentals are there long term to drive substantial improvements in the pricing environment. But on a short-term basis, there's been unprecedented volatility over the last 2 years.
Yep. Any final comments on the spot market? No? Let's have a round of applause for the panel. Thank you.